explain the accounting treatment for both assets in the financial statements. Our year end is 31st December. Now we have a class of assets, and those assets are being depreciated 10% straight line. So that's a very nice, simple maths. One asset cost 20,000. At the beginning of the year, the asset is 4 years old. So that means we would have charged 2, we would have charged 8, the opening net book value is 12. In September, 9 months into the accounting period, we decide to sell the asset. We instruct an agent. The asset has not yet been sold, but several people are interested. The asset works. The asset is being marketed for only 3. That's a pathetically small amount of money, given the carrying value was 12. But it is, however, the going rate for the asset, and there is an agent's commission of 10%. So, simple question, yes or no? Yes, it clearly meets all of the conditions. Now what we've got here in the classroom is an artificial environment because I have just gone through the definition of held for sale. But what you will find in the exam is the situation being described in the middle of a question, and you will have to remember that when somebody has decided to sell an asset and decided to sell it for the right price, and they are serious about going about it, but they haven't quite yet sold it at the year end, then you've got to remember held for sale. And even if the numbers aren't there, it could just be a discursive point that you have to then to write it down. So we are now going to recognise a recoverable amount. So I'm interested in covering ground. You seem to be quite comfortable. The conditions are all met. The conditions are all met. And therefore, it is held for sale. And it becomes held for sale on the 30th of September. And therefore, it is on that date that we do the impairment review. So as a result, there is an impairment review conducted on the day that we classify the asset as held for sale. So I will need to know its carrying value. This is 9 months into the accounting period. 20 minus 2 minus 2 minus 2 minus 2 gives us an opening balance of 12. We then would, of course, depreciated the asset up to the date of the classification. So the amount of depreciation would then be 20 at 1/10 at 9/12. Why 9/12? Because 30 September. I haven't got a calculator with me today. So 12 minus, that's 1.5, that's 10,500? 10,500. So your carrying value is 10,500. What is your recoverable amount? Your recoverable amount, the only way you recover an asset that is held for sale is from selling it. So it's the fair value less cost to sell. By definition, the value in use is not pertinent, is not appropriate, because you are committed to selling the asset. So the fair value less cost to sell, you're selling it at that reasonable price. The agent's commission means we're only going to get 2,700. So this means that we have an impairment loss. This means that we have a write-down. The asset has not previously been impaired, so therefore this loss will go directly into P&L. This loss is 7,000. 7,800. For the avoidance of any doubt whatsoever, I am presenting this information on the balance sheet. I have a statement of financial position. I have a current asset, which is PPE held for sale, and that would be at at 2,700, and in my profit and loss, I would have a depreciation charge of 1,500, and I would have an impairment loss of 7,800 for the avoidance of any doubt. And I can see very easily how this could be part of question number 1 of group accounts, because you could get this little story as a footnote, and it would mean that you take something out of PPE and put it into current assets. It means that you would have the time portion of the depreciation up to the reclassification, and you would have an impairment loss in P&L because the asset has not previously been revalued. Going? Going? Oh, one last thing. Framework. 2 fundamental characteristics of useful information. If information is to be useful, it must be F and it must be R. F stands for faithful representation, true and fair, substance over form. What does the R stand for? Relevant. So we touched on this the other day, we touched on this last night, about having an investment property at fair value is being relevant because it's being predictive. So when you use fair value, you're being relevant, you're being predictive. That presentation is predictive, because you're telling your investors this asset won't be there next year. Normally, PPE is a non-current asset. But you are now saying this item of plant is here today, gone tomorrow. So the standard is an embodiment of the principles within the framework that information, if it is useful, needs to be presented in a relevant way. So this, is an example of a relevant presentation. This is relevant because it is being predictive. Blah, 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 blah. You can relate it back to the framework. So the first thing we have done there is to look at asset number 1. Let's have a look at asset number 2. Another such asset cost 30,000. At the start of the accounting period, it was 6 years old. 30,000 will mean depreciation of 3. 6 years of depreciation of 3 is 18, so this asset also has an opening carrying value of 12. Once again, in September, we decide to sell the asset, and once again, we instruct a buyer. The asset hasn't been sold yet. Now, this is partly down to the fact the asset is broken, has subsidence, has asbestos, doesn't have a health and safety certificate. So it's in need of repair. 1 month after the year end, A, we repair it, and B, we sell it. And we sell it at a juicy 24,000. That's lovely. Agent's commission, financial statements are signed off. So by the time we have signed off the financial statements, the asset has already been sold. Is this asset held for sale, yes or no?
No. No, it doesn't meet the condition.
When do the conditions have to be met? At the date the accounts are signed off, or does the conditions have to be met at the reporting date? At the reporting date. And at the reporting date, what condition is not met? It's not a suitable condition for immediate sale. The fact that you repair the asset after the year end is a non-adjusting post-balance sheet event. Because by repairing the asset, By repairing the asset after the year end, you're not changing the condition of the asset at the year end. So at the year end, on the day you draw up the balance sheet, it's a broken asset. So it doesn't meet the conditions. Even though you've repaired it, even though you've actually sold it, the repair and the disposal are non-adjusting events, and for that reason, it is therefore part of PPE. You'll continue to depreciate it. The fact that you've decided to sell it triggers an impairment review, but I just can't see the numbers giving me an impairment loss, given you're selling it for so much. So the criteria here are not met, and that needs to be explained. So, yeah. The conditions are not met at year end. At the year end, it is in a state of disrepair. It is in a state of disrepair, and therefore not in a suitable condition. And therefore not in a suitable condition for immediate sale. Not in a suitable condition for immediate sale. The subsequent repair, the subsequent sale, is a non-adjusting event. So at the year end, it's in a state of disrepair. It's not in a suitable condition for immediate sale. The subsequent repair and sale is a non-adjusting event. So therefore, it is PPE, it is a non-current asset. The fact that you have decided to sell it and reorganize means that you would trigger an impairment review, but there is no loss. The decision to sell would trigger an impairment review, yeah, but there's no loss. But no loss arises. So there is nothing to anticipate. So the decision to sell would trigger an impairment review, but no loss would arise. I'm happy. I'm very happy. If we wanted to do an extract from the accounts in respect of this asset, then effectively on your statement of financial position, there would be a non-current asset which is PPE, and that non-current asset which is PPE is now effectively 7 years old, and therefore if the asset costs 30,000, yeah, you've only got 3/10 of that. You've got an asset in the books at 9, and in your P&L you'll have a depreciation of 3. You cannot make a provision for the future repairs of the asset. You don't make a provision for future repairs. Held for sale. Held for sale. So having looked at held for sale in that context, let us now also then think about discontinued operations. Yeah, let us now think about discontinued operations.